Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So this week, we got what one market watcher referred to as, quote, one of the most phenomenal data points that we've gotten in years, even decades, unquote. Well then, what is this data point, you ask? Productivity. It jumped 4.9% in Q3, a tick short of the estimate, but up from 3.1% in the year-ago quarter. Productivity has only hit this level 3 times in the past 20 years, so I get it. But the excitement, of course, comes from the fact that it happened amidst all of the AI promise/hype and investment. For what it's worth, Goldman Sachs research says that today only 6.1% of all U.S. companies are leveraging artificial intelligence to create goods and services. Now, we know that productivity gains are more than what is derived from AI. In any event, productivity, the bridge between the labor market and growth, is going to be the economics word of the year. You heard it here first. This week, our three things are: 1. Housing headwinds. Are we close to unlocking real value? And 2. Big bank credit color. Where do the cockroaches go? And 3. Supply surge. 2026 figures to see record-setting issuance. What does it mean for spreads? All right, let's dig a bit deeper. Housing headwinds. As we head into midterms year, we have highlighted for some time now that you can expect the administration to roll out a number of initiatives aimed at the affordability issue. 2 of those came out in the past couple of weeks, targeting housing, a sector that accounts for anywhere from 15 to 18% of U.S. GDP, according to the National Association of Home Builders. Housing affordability is at or near a 50-year low for a variety of reasons, so says the National Association of Realtors. Mortgage rates have surged, making growth in the average monthly mortgage payment far above the growth in wages. Higher rates have also locked in homeowners with much lower cost mortgages, keeping resale inventory low. Moreover, mortgage availability has been constrained ever since the GFC, as tighter underwriting standards have entrenched. On top of that, homebuilder sentiment has remained depressed ever since the pandemic, with builders worried about not only demand in the face of higher mortgage rates, but also the cost and supply of labor and materials. Now throw into the mix diminishing consumer confidence, where those expecting higher unemployment within a year is spiking, and surveys of home buying conditions have plummeted. Banning institutional purchases of homes we don't believe will move the needle on affordability. Institutional demand is a nearly immaterial source of overall demand. Moreover, it could even cause builders to build less if they know that they've lost a buyer that typically takes up 5% of their product. Buying substantial amounts of mortgage-backed securities can lower mortgage rates, as we've seen over the past week or so. The administration is using existing cash to fund the $200 billion purchase of MBS. The problem is that you would need to buy a whole lot more to make a lasting impact on rates. That moves into quantitative easing territory that would have to be funded, presumably, by additional borrowing, which would be expensive to issue and hedge. It would also fan the flames of inflation, which is threatening to break out to the upside on the back of other stimulus. Remember, tax cuts and breaks, infrastructure spend, rate cuts, etc., all on the way. So increasing demand for housing ultimately defeats the purpose of the exercise if you don't increase the supply of homes. That's the rub. You need to increase the supply of homes with incentives, which will require trade-offs, and probably a public-private partnership. At the end of the day, there isn't a quick fix to this problem. All right, on to our second thing, big bank credit color. So earnings season has begun, and that means the largest banks, JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup, weigh in with their latest reserving exercise for expected future loan losses. To set the stage, we were conditioned to be on cockroach alert. Where there's a handful of cockroaches or bad loans, there surely are more. And that means lenders, in this case the largest lenders, the largest banks, and their regulators, had every incentive to find more cockroaches, get it all out there. Well, at least as the large banks are concerned, they didn't find a material increase judging by their latest results. First, the data. Let's start with total loan loss reserves. As a percentage of total loans, that ratio went down at all four of the largest banks. That's a good sign. Skeptics might wonder if they're hiding problems by under-reserving. It's not likely. Banks have to justify loan loss reserving, whether they're building reserves or shrinking them. Auditors inside and out check for veracity. Regulators check. The IRS checks. The market expects. The system of control is hardly foolproof, but it's pretty good. What about non-performing loans? They remained low at all four banks. Only Citi saw their ratio of non-performers to loans rise, but the overall level remains low. On the consumer side, similar views from all. B of A pointed out that, quote, delinquencies and charge-offs improved in 2025 consumer credit as unemployment remained stable and the equity market appreciation benefited those consumers that were invested. This strong consumer health bodes well for the continued improvement in growth in 2026. Wells added this. We also monitor consumer behavior more broadly to help us understand consumer health. For example, we look at things like checking accounts with unemployment flows, direct deposit amounts, overdraft activity, and payment outflows, and we've not observed meaningful shifts in trends, unquote. As far as commercial lending is concerned, B of A CEO Moynihan commented that businesses had a pretty good year and good profits, resulting in good credit quality. Tariffs appear to be manageable and deregulation kicked in. Risks remain out there, they always do, but we're encouraged and constructive on the year ahead. Wells did not see any signs of systemic weakness across the portfolio. It's worth noting that JPM signaled, quote, on the margin, and it's a very small margin, downgrades are exceeding upgrades by a little bit, causing the bank to make some parameter updates to assume slightly higher loss given default in the commercial loan book. CFO Barnum was quick to point out that management is not seeing anything concerning in a broader sense. He also pointed out that when it comes to commercial charge-offs, the numbers have been running at exceptionally low levels for a long time as the portfolio has also grown. So, simply bringing that back to slightly more normal through the cycle charge-off rates would still involve some increase in charge-offs. You're worried about CRE? We have long said it will be a slow bleed, and that's good because over time there will be a wall of earnings generated by lenders that can easily absorb write-downs in the sector. Wells breaks out its CRE nonperformers, and yes, that level remains high at nearly 3% of CRE loans, and that ratio rose from a year ago. But the overall drag on Wells' results remains quite modest. Management commented that office valuations continue to stabilize, and although we expect additional losses, which could be lumpy, they should be well within our expectations. B of A highlighted lower losses in its CRE book. Add it all up, and for bankable credit, and that's an important caveat, loan quality remains quite high. There is little evidence of cockroaches. We'll get better color out of riskier lending, consumer subprime, and leverage finance in the upcoming weeks. All right, on to our third thing, supply surge. There was a time when new issue supply was a very meaningful technical factor influencing credit spreads. I think those days have passed. Or maybe it's just this environment where the backdrop is good enough for credit, but uncertain enough to think twice about buying stocks at a mid 90s percentile valuation. Or cash where yields are declining. Or rates where you're not fooled by the latest move index reading that has fallen 35% below its 20-year average when it was 60% above less than a year ago. The appeal of credit and its recently broadened array of offerings and where there is something for just about everyone is plainly evident, especially in this environment. So what we might call heavy new issue supply is not likely, in our view, to overwhelm demand. How heavy a supply? Well, upwards of $2 trillion or more, that would be record setting, in public investment grade paper in 2026. Morgan Stanley expects 2.3 trillion or 25% above what it counted as 1.8 trillion in 2025. And for what it's worth, Bloomberg concurs with that 2025 amount, which bounces around depending on who calculates what. JP Morgan Chase is looking for 1.8 trillion. That would be a 17% increase over its 2025 amount that it calculates at 1.5 trillion. Bank of America is looking for an 11% increase in 2026 to 1.8 trillion, while Deutsche Bank sees 1.7 trillion, a 10% increase over its tally for 2025. Deutsche notes that 2026 net supply will grow to 814 billion. That's a 52% increase over 2025's level. Now, driving the increase in 26 is another healthy dose of AI-related issuance from the hyperscalers and a healthy pickup in M&A-related financing now that the shackles of the previous administration have been removed, freeing up acquisition animal spirits. While we do believe there could be some indigestion related to AI-related issuance, as investors bump into single-name limits and some of the more skeptical worry about a possible AI bubble. But leaving that aside, we believe we remain in a world where there isn't enough bonds to go around to meet demand. With public IG yields now 68 basis points above its 20-year average and fundamentals good enough for credit, we see the once feared technical of heavy supply tamed in 2026. So there you have it. Three things in credit. One, housing headwinds. Addressing affordability requires bolder thinking. Two, big bank credit color. Fears of credit quality deterioration are misplaced, at least among the largest lenders. And three, supply surge. Bond scarcity is real. Record supply is not likely to lean materially on spreads. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.